In this video, we will explore the index management and major indices in India, specifically focusing on the methodologies used for their construction, maintenance, and revision. Understanding these processes is essential for anyone looking to grasp how the pulse of the market is measured. To begin, let us look at the index management ecosystem. In India, the construction, maintenance, and revision of indices are not handled by the exchanges themselves, but by specialized agencies to ensure market integrity. For example, the BSE Indices are managed by Asia Index Private Limited, while the NSE Indices are managed by NSE Indices Limited. These agencies ensure that every index remains a reliable reflection of the market. When building a robust index, the most important principle is the trade-off between diversification and liquidity. A well-diversified index reflects the behavior of the overall economy and helps reduce risk, but only up to a point. As you can see on the chart, moving from 0 to 20 stocks results in a sharp reduction in risk. However, as the number of stocks grows from 50 to 100, we see diminishing returns. Once an index goes beyond 100 stocks, there is almost zero decline in risk, meaning there is little to gain by diversifying further. The selection methodology follows a structured funneling process. It starts with the universe of stocks, which is a broad review of all potential candidates. These candidates are then filtered through eligibility parameters, which are specific quantitative and qualitative criteria set by the managers. Once a stock satisfies these criteria, it is entitled for inclusion. Finally, a specialized group known as the Index Committee makes the final decision on whether to include or remove a security. Once an index is created, it requires ongoing maintenance to ensure comparability over time. Maintenance involves using mathematical formulae to account for corporate actions. These actions include things like dividends, bonus issues, rights issues, stock splits, consolidations, and mergers. The goal of maintenance is to ensure the index value remains consistent and comparable across time, despite these structural changes in the underlying companies. While maintenance deals with technical adjustments, index revision is about strategic evolution. Revision is a continuous exercise where existing stocks are replaced with new ones. This is done to reflect changes in the trading paradigm or shifts in the interests of market participants. The ultimate goal of revision is to ensure the index always captures the most vibrant lot of securities in the market. It is helpful to understand the key distinctions between maintenance and revision. Index maintenance is mathematical in nature and is triggered by specific corporate actions like splits and dividends. Its primary focus is on numerical comparability, which is achieved by adjusting the index formula. In contrast, revision is a strategic process that changes the actual composition of the index to keep it relevant to the current market environment. Finally, let us look at the major equity indices in India. The S&P BSE family include the Sensex, Next 50, and broader indices like the S&P BSE 100, 200, and 500. Similarly, the Nifty family features the Nifty 50, Nifty Next 50, and the Nifty 100, 200, and 500. Other notable indices include the SX 40. These indices serve as the primary benchmarks for investors across the country.